Third topic is about regulated sources of information. From Learning Module, Introduction to Financial Statement Analysis. IOSCO is a global group of securities regulators. Their job is to make markets work well and safely. Their three core objectives are about protecting investors, making sure markets are good, and reducing big system-wide risks. Note, reducing, not eliminating. Option B directly matches one of the three explicit core objectives. Option A, IOSCO aims to reduce systemic risk, not eliminate all market risk. Option C, IFRS are established by the IASB, International Accounting Standards Board, not IOSCO. IOSCO is a securities regulator organization, not a standard setter for accounting rules. The main financial statements, balance sheet, income statement, show summary numbers. The notes provide the essential details, explanations, and breakdowns needed to truly understand those numbers. Without them, the statements are incomplete. Their primary job is to explain and clarify not to force uniformity or replace the audit. Option B directly matches the document statement that notes provide essential details about policies and line items. Option A. Notes disclose differences in accounting methods. They don't force identical methods. The document states standards allow flexibility in policy choices. Option C. Auditor's reports are separate required components. Notes complement statements. They don't replace independent audit opinions. Depreciation assumptions are technical accounting details required by standards to be disclosed in notes, not MD&A, commentary, or proxy governance documents. MD&A may mention why a policy matters strategically, but the specific numbers or methods live in the notes. Proxy statements deal with people or governance, not accounting calculations. What executives receive, such as actual compensation amounts or grants, is in the proxy statement. How compensation is accounted for in financial statements, such as expense recognition, valuation methods, is in the notes or MD&A. Compensation arrangements live in the proxy. Compensation accounting lives in the notes or MD&A. Notes disclose accounting policies for compensation, such as how stock options are expensed, not the actual compensation amounts or grants. MD&A discusses critical accounting policies affecting results and business outlook, not compensation details. MD&A may mention compensation expense impact, but not grant specifics. Management commentary, or MD&A, is management's forward-looking narrative about strategy, objectives, and future direction. This is a section where company leaders explain their vision, long-term goals, and how they plan to achieve them. It often includes discussions about risks, opportunities, and future strategies. Notes are the backward-looking technical details about how numbers were calculated. Notes to the financial statements provide extra details about the numbers in the financial reports, like accounting methods or assumptions, but not the company's big-picture goals. Auditor's report is the independent opinion on historical statements, not business strategy. Auditor's report is a statement from an independent auditor saying whether the financial statements are accurate. It doesn't talk about the company's goals or plans. At first means the auditor says the financial statements are not reliable. Statements materially depart from standards and are not fairly presented. At first is very bad. The financial statements cannot be trusted. Unqualified means clean opinion. The auditor says the financial statements are fair and accurate. Statements fairly presented per standards. Analysts prefer this. Unqualified is good. No major problems found. Qualified means the auditor found some issues. For example, disagreement with accounting methods, but thinks the rest is okay. Qualified means some problems. Exception or scope limitation exists, but statements mostly reliable. Qualified opinion means the auditor found a specific issue, such as departure from accounting standards, but the rest of the financial statements are fair. Disclaimer of opinion means the auditor cannot form an opinion, for example, due to lack of information. No opinion given is rare. Adverse opinion means the auditor believes the financial statements are not reliable overall. Adverse opinion is a total rejection of the financial statements. Very serious. Auditors provide reasonable assurance, not absolute assurance. Reasonable assurance means the auditor obtains sufficient evidence to conclude the financial statements are free from material misstatement. This is the standard definition of audit assurance. Option A. Absolute assurance is impossible due to inherent limitations, use of sampling, accounting estimates requiring judgment, and potential for fraud. Audits do not provide absolute assurance or guarantee precision in all respects. Option B. Limited assurance applies to review engagements, not audits. Form 10Q is filed quarterly, 4 times a year. It includes unaudited financial statements and a shorter management discussion and analysis. So, 10Q is unaudited and shorter. The quarterly report is quicker and not audited. Form 10K is filed annually with the SEC. It includes audited financial statements and detailed information about the company's business, risks, and management. So, 10K is audited and detailed. The annual report is more thorough and checked by auditors. Option C is a trick. Both are periodic, but the audit status and MD&A detail are the real differences. Sarbanes-Oxley Act, or SOX, focuses on making sure companies have strong internal controls, systems to prevent errors or fraud in financial reporting, and that management is held responsible for accuracy. Option B is correct. SOX requires management to report annually on whether the company's internal controls over financial reporting are effective. Option A. Management does not appoint the independent auditor. The audit committee does, to avoid conflicts of interest. Option C. Financial estimates always involve some uncertainty, for example, predicting future sales. SOX doesn't demand perfection, just honest, reasonable estimates. The SEC requires public companies to file regular reports with detailed financial and operational information. These reports are public and help investors make informed decisions. Form 10K is the official annual report filed with the SEC. It includes audited financial statements, detailed business info, and risks. All public companies must file it every year. Option A. Annual report to shareholders is a document sent to shareholders, owners of the company, but is not filed with the SEC. It may include similar info as the 10-K, but isn't the official SEC filing. Option B. A separate, abbreviated quarterly report to shareholders is a shorter update for shareholders, like a summary of quarterly results, but it's not required to be filed with the SEC. The SEC requires a different quarterly report, Form 10-Q. Form 10-Q is an interim report filed quarterly with the SEC. Contains unaudited financial statements. It presents condensed financial information, shorter, less detailed, rather than full annual statements. Notes and disclosures are less comprehensive than in the annual form of 10-K. In auditor's role, an independent auditor checks a company's financial statements to see if they follow accounting rules, GAAP, and are free from material misstatements. The auditor's report shares their opinion on this. Under SOX and PCAOB auditing standards, the independent auditor must also express an opinion on the company's internal control over financial reporting, or ICFR, for most public companies. Management's responsibility: assess and report on ICFR effectiveness. Auditor's responsibility: attest to and express an opinion on both the financial statements and ICFR effectiveness. The dual opinion requirement, financial statements plus ICFR, is specific to U.S. public company audits under SOX. Option B. Auditors do not guarantee the financial statements are 100% accurate. They provide reasonable assurance, a high level of confidence, but not absolute certainty. Option C. The auditor's report must be prepared by an independent, an external auditor, not the company's internal audit department, which works for the company and isn't independent. IOSCO doesn't make accounting rules or enforce laws directly. Instead, it helps countries work together to create consistent rules and share best practices for regulating securities markets, such as stocks, bonds, etc. It connects securities regulators like the SEC, UK's FCA, to share ideas. The focus on cooperation. Markets are global, so regulators need to work together to stop fraud or crashes. It doesn't write laws like IFRS or punish companies. It helps countries do that better. Option A. IFRS are made by the IASB, not IOSCO. Option B. IOSCO doesn't directly enforce laws. It helps member countries improve their own regulations and cooperate. Management commentary, MD&A, includes management's objectives and strategies, analysis of liquidity and capital resources, discussion of future prospects including planned capital expenditures, forward-looking information about cash needs and funding plans. The financial statements that contains balance sheet and statement of cash flows is the historical record of what happened. MD&A is the management's narrative explaining results and discussing future expectations, including liquidity needs and capital expenditure plans. Notes are required and provide information essential to understanding the financial statements. Notes disclose the accounting policies, methods, and estimates used to prepare the statements. They help users understand how the numbers were calculated and what rules were followed. Notes explain rules and estimates used in the financial statements. This is their primary purpose of notes. Option B. Management's forward-looking views, like future plans, are in the MD&A, not the notes. Option C. Auditor's opinion is in a separate auditor's report, not the notes. The IASB practice statement identifies 5 elements of decision useful management commentary: management's objectives and strategies, results of operations, indicators of performance, resources, risks and relationships, and outlook. Option A matches the first required element exactly. Option B. Detailed asset listings belong in the notes to financial statements, not management commentary. Option C. Journal entries are internal accounting records and never disclosed in management commentary. Fourth topic from Learning Module, Introduction to Financial Statement Analysis, is about comparison of IFRS with alternative financial reporting systems. IASB is the independent standard setting board that develops and issues IFRS. It is the operating board that writes standards. IFRS Foundation is the oversight body that governs the IASB, but does not develop standards itself. It is the legal entity that oversees the IASB structure. IOSCO is Securities Regulators Organization that endorses IFRS for cross-border use, but does not create accounting standards. IOSCO is a separate regulators organization that supports IFRS adoption, but plays no role in standard setting. FASB is the independent organization officially tasked with developing and issuing US GAAP. SEC is the US government agency that oversees financial markets and enforces securities laws. It can set rules but delegates US GAAP development to another group. PCAOB is a board that sets auditing standards for public companies, not accounting rules. Fifth topic from Learning Module, Introduction to Financial Statement Analysis, is about other sources of information. Proprietary primary research is the original research done by the analyst. For example, surveys, interviews, or mystery shopping to gather first-hand data about customer experience. First-hand is direct. The analyst wants to see, hear, experience it themselves, not relies on others. Issuer sources are the information from the company itself, like annual reports, press releases, or websites. These are useful, but may be biased or incomplete. Public third-party resources are the data from outside groups like industry reports, news articles, or reviews, but not directly collected by the analyst. Issuer or third party is not direct. Company reports or news articles are useful, but not first-hand.